Buying S&P 500 LEAPS options is a very viable strategy with significant results over the past 10 years. But this begs the question, aren't there some months, some periods of time over the past 10 years that were really, really bad potentially for buying LEAPS options? Yes, there were, and we don't run away from the reality, from truth. So let's talk about them. What's up, you guys? Welcome back to the Average Joe Investor channel. We've done now 2 different videos of talking about purchasing LEAPS options as part of your long-term capital growth strategy, particularly in your retirement accounts, but also in your brokerage accounts as well. We're not talking about creating income necessarily with these portfolios. It's about growing long-term for the future. And we back-tested the S&P 500 purchasing SPY LEAPS options on a recurring basis, and those results were significant. They were amazing. But the reality is I picked a specific date in October and did it on an annual basis just so I could get 10 full years through October 2024. The reality is not everyone's going to use October. Some people will use December, and there were specific times in the past 10 years where it would have been really bad timing-wise to own and actually turning over on these S&P 500 LEAPS options. Specifically, during this 10-year period from 2014 through 2024, there are clearly some times where you didn't want to be holding SPY LEAPS options if you had to renew them after 1 year, which is what the strategy I talked about. Particularly right here in COVID, maybe right here in 2018, right down here in 2022. And so what I did was I pulled out 5 different specific dates that it would have been a terrible idea to have to then roll out of your SPY LEAPS option strategy. And I wanted to really quantify what those losses would have looked like. And then we'll talk about, given those losses, however bad or good they actually are, would that have totally wrecked the strategy or not? So given that introduction, let's dive in. This spreadsheet, along with all of my other spreadsheets, are available to the members of the Average Joe Investor Patreon community. So if you're interested in learning more about that community, what amazing benefits you have to offer, the amazing community you get to be a part of, check out the link down in the description below. So what we've got here is 5 different examples. We're going to start with number 1 here. Example number 1, worst days of the S&P 500 since 2014. And what I did was I took the bad day, I started there, and then given the fact that I talked about rolling over these SPY LEAPS strategies on an annual basis, with every new LEAPS option you own, the goal should be to purchase it with the farthest expiration so there's the most amount of time available. So that way the amount of time left over after a year is maximized, so the amount of theta decay on your options is minimized. Sorry if that was a little bit confusing. So essentially what we've got here is I started with the bad day. First one was March 1st, 2016. And then I assumed then if I was rolling over my LEAPS options on this date, that I would have to have purchased it 1 year early. So we got right here, 3/2/2015. Now at that time, 3/2/2015, the expiration I would have gone for is 12/15 of 2017. And I assumed that on that date, the 2017, which you can see right over here, here are all the screenshots from my market back testing software from Market Chameleon, I would go right at the money, which is 2/10. And I would purchase that LEAPS option, and then we would move forward to that worst day to own it and figure out what those losses would have been. So going back over here, if we opened an at-the-money LEAPS option on the S&P 500 back on March 2nd, 2015, with this expiration date, the strike price would have been 210. Now, the market price again was 210, and the market price on March 1st, 2016 was $200, so a loss of $10 per share. So the option value, as it turns out, on that opening date was $2,400, and I just took the bid and the ask and then did the middle of those, the average. And then fast forward a year, that option contract initially worth $2,400 was now only worth $1,650. The loss here, the real loss of the option value once it was rolled over, was $750 or 31%. Now this next section here I find really unique and interesting. What I wanted to do was say, well, what would the results be with this option strategy? Obviously, in these worst days, what was the actual real dollar amount lost and the real percentage of value lost, the profit or loss? But I also wanted to compare that to, if you hadn't done that, if you hadn't done the LEAPS strategy, what would you have done with that capital? You would have invested it into the S&P 500 in actual shares. So I wanted to say, apples to apples, if you take that same $2,400 and you put it into shares of the S&P 500, what would have been the real loss in dollars during that same time frame and the same percentage? So what you can see is that same $2,400 right here could have been used to purchase 11.43 shares of the S&P 500 on this date. And if you take that change in value from 210 to 200, that would mean a real share result of $114 or a loss of value of 5%. Shares are going to be less volatile than purchasing LEAPS options, no matter if it's at the money, in the money, or out of the money. And this is the key with LEAPS options. When you lose money, you're going to lose money big, unless the market is flat, in which case you're still going to lose quite a bit of value because a lot of that theta time decay is occurring. But when the market is up on SPY LEAPS options, remember, you get significant growth, multiples, exponential growth that far outweighs the amount of losses. But I want to still be very specific about the differences here between losses of share value and the losses of SPY LEAPS options value. And again, all of the screenshots here are here just to show that I really backtested this result here and here. Let's move to example number 2. This would be the worst day here, which was the worst day of COVID, March 16th, 2020. Now I worked it backwards here. I assume that if this was the bad day that I had to roll my option over, I would have actually opened it on March 15th, 2019 with this expiration here, 12/17/2021. And the market price at that time was 281. And so that's the strike price that I used. You can see that right over here. I'm going to move this over. 281 right here. Here's the bid and the ask. So that option contract, that SPY LEAPS option that I purchased would have cost me $3,300. And if you fast forward 12 months, the market price was 240, which was bad, right? 281 down to 240. And my option contract had eroded from 3,300 down to 1,700, which was an actual real dollar loss of $1,600 and a profit loss percentage of 48% erosion of value. Now, if you'd taken that same $3,300 and instead of buying the SPY LEAPS options, you had instead purchased shares of the S&P 500, you would have purchased 11.74 shares right here. And those shares would have lost $481 of value, or 15%. So clearly we're seeing a trend here. The shares are definitely going to be less volatile if you experience losses. Example number 3. Right here we've got the third example, June 13th, 2022. So we worked backward here. So that means I would have opened the option June 11th, 2021. And that would have been an expiration I would have looked at of 12/15/2023. At that time, I'm going to zoom over here. The market price at this time was 425, essentially 424.24. So I went with 425. And the option contract would have cost me $4,450 to purchase that LEAPS option. Fast forward 12 months to that bad day, June 13th, 2022. The market price went from 425 down to 375. And my contract, as a result, would have gone down from 44.50 down to 25.50. That would be a profit or loss here of $1,900 or 43% of the value. Instead, if I had purchased the shares of the S&P 500, I would have been able to purchase 10.47 shares at that time, and I would have lost, during that same time frame, $524 in value, or 12%. Example number 4 of 5, we've got 9/26/2022, which means if you work backwards, I would have opened the option 9/27/2021 with an expiration of 12/15/2023, which we can backtest. At the time, the market price, let me scroll over here. Market price was 445, and this is the option bid and the ask. Means the option contract would have cost me $4,900. Now, if we fast forward 12 months, the market price went from 445 down to 385. And as a result, my contract went down in value from $4,900 down to $1,950, which is significant. A loss of $2,950, which is a 60% drop in the option contract value. And if I had instead purchased the shares, I would have purchased 11.01 shares back on 2021. And I would have lost value of $661, or 13%. Lastly, option number 5, or example number 5, 10/23/2023 is the bad day. So working backwards, we would have opened it on 10/24/2022. Expiration would have been 12/20 of 2024. At the time, the market price, let me scroll over here for full honesty and transparency, 385. There's the date. For this one here, even though it was a bad drop, it actually, over the course of a year, actually was very profitable, ironically. So the market went from 10/24/2022 to 10/23/2023. Market price went from 380 to 431. So the option value went from 63.94 to 82.27, which was actually a 29% increase in the value of the contract, or $1,833 in value. And then the real shares would have been 13% up, or $858. So here's a clear example of when the LEAPS option outworked owning the shares. Now, despite example number 5, the first 4 were no bueno. So then that begs the question, if these are the real potential losses that you may realize with this purchasing of S&P 500 LEAPS option strategy, does it make sense to do it at all? To answer that question, you need to look at the corresponding 12 months after these bad months. Even if you were as bad timing as it would possibly be to have to roll over your option contracts at these worst times and experience these real losses, what were the next 12 months like? Because that matters. If you have 2 bad months or 2 bad years in a row, then that might really create some serious doubt potentially over the long term. But what happened in those 12 months? Going back over here to example number 1, remember we had a $750 loss or 31% down. Market went from 210 to 200, but the next 12 months, if you look right here, market went from was like 202-ish all the way up to 240. Pay no attention to the 570, that's today's price. Right up here to 240. So that was a real increase here that's pretty significant. How about example number 2? Example number 2, the market went from 281 down to 240, but what about the next 12 months? Market went from 240 all the way up to 380-ish, 380, 385. Very significant increase there that was going to be very profitable for your LEAPS option strategies. Example number 3. June 13th, 2022. What about, and we went down in market price from 425 down to 375. But if you look at the next 12 months result, we go from right here, 375-ish, 380, all the way up to 440, 435. So another big increase here that's going to be profitable for future LEAPS option strategies. Example 4, this would have been a tough one to swallow, right? 60% drop in your option contract or nearly $3,000. Market went from 445 down to 385, but what about the next 12 months? Up from here, 3-ish, 370, 385, all the way up to 425. So we had a big increase here as well that was going to be profitable for your LEAPS option strategies. And then scenario 5 here, very significant, right? 425 all the way up to nearly 575. So the big takeaway from this is even if you were to get the timing all wrong and you had to roll your LEAPS options at the worst possible times over the past 10 years, the next 12 months were massively profitable for your next LEAPS option strategies. And while I didn't back those specifically, when you are seeing market increases of 20, 25, 30% year over year, that's going to be extremely profitable in the 200 to 250% increase depending on your LEAPS option strategy. So fear not here when it comes to utilizing S&P 500 LEAPS option strategies. If combined with owning the shares of the S&P 500, they've been massively profitable over the past 10 years. Now, the future could be entirely different, and the likelihood of us seeing significant gains, just like we did in the past 10 years, is probably low. But as long as we're getting 10, 11, 12% growth, even higher on some years out of others, the massive exponential gains in these LEAPS option strategies are going to outweigh the losses. At least that's what history has told us. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. I'm always curious to know your feedback. That's all I got for you guys. Have a great rest of your day, and thanks for watching.